Good afternoon, everybody. Thank you very much for joining us today. The team here at 8 Wealth International, very grateful to have you guys joining us. And we are here today to give you a whistle-stop tour of some of the biggest tax mistakes that individuals make, both in the UK and in Asia. My name is Ian Riggs, and I'm the CEO of 8 Wealth Management in the UK, and we're very excited to spend the next 45 minutes to an hour with you. So thank you again for your attendance. Just going to kick off by giving you a bit of an overview about our business. So we can have the next slide, please, Helen. Perfect. So who are 8 Wealth International? We are a wealth management company specializing in financial advice and tax and legacy planning, based here in Singapore. And we also have a fantastic team based in various locations throughout the UK, some reputation in Shanghai as well. Our business, next slide please, Kelly, if you don't mind. So we are a firm of professionally and highly qualified financial advisors, as I said, specializing in tax and legacy planning. We are proud to be a principal partner practice of St. James's Place Wealth Management, and presently across those jurisdictions, we are looking after in excess of 10,000 clients and holding and managing investment assets in excess of 2 billion sterling. We have a fantastic team of extremely experienced wealth management consultants and support staff. And we have recently integrated our business into Singapore, where I am delighted to be presenting you from today. The plan for today is, sorry, Helen, next slide, please. Basically, the overview today is very simple. We're going to talk to you about stealth taxes and your wealth, how you can protect and manage your legacy, cover off some pension opportunities, as well as talking to you about the lifetime allowance and other pension allowances. We're going to cover the importance of advanced repatriation planning, also about wills, guardianships, powers of attorney, and in addition to that, talk about final salary or defined benefit pension schemes. Next slide, please, Helen. We've got a Q&A session that we're going to run throughout this webinar. So you will see there is a Q&A box below. Please post away any questions as we go through this webinar. I will pick them up at the end. And in addition to that, if there are any other questions from the audience, please raise your hand, and I'll cover those off with our expert speakers at the end of today's session. So I'd like to kick off by just introducing our two key speakers today. Kelly Gregg, who has recently, literally in the last month, joined us here in Singapore, having spent over 18 years as a lawyer in the UK, very much specializing in legacy and estate tax planning, and a former head of the UK STEP Committee. So welcome, Kelly. And also to Giles Henman, the head of our Asia business and also a senior partner. Giles is a chartered financial planner and is uniquely placed to advise people both in Asia and in the UK. So two fantastic, highly experienced experts. I'm going to hand you over to now, kicking us off with Mr. Henman, who's going to talk you through the subjects along with Kelly. Hope you enjoy.
Thank you, Ian. Next slide, please. So we're going to start with pensions, a slightly dry subject. And our plan today is for me and Kelly to effectively try and work through these slides very quickly at high level, work together on the various different subjects. What we would say is any deeper information that you need after the meeting, please feel free to reach out. But there's a lot to cover, so let's kick on. So next slide, please. So we're going to ask you to think slightly differently about pensions in the future. Potentially is not a form of income through retirement, but maybe a way to mitigate tax, both in terms of income tax that you pay today or maybe in the future, and also inheritance tax. So looking at it from a legacy perspective in the future, it's becoming increasingly difficult to put large amounts of money into a pension. In the last 10 years or so, there's been limitations put on the amount of money you can save in a pension on an annual basis, but also the maximum amount you can save before you incur an additional tax liability. In 2006, the lifetime allowance was introduced at 1.8 million. This is decreased on a regular basis until a point a few years back where it was reduced to £1 million, and since then has increased in line with inflation, but effectively has been held at the current level of 1.073 million and £100, a very, very strange figure. It's going to be held at that until at least 2025. So it means that more and more of us, you, are going to effectively have restrictions on the amount of money that you can build up in a pension. If you breach that level now or in the future, then you're subject either to a 55% additional tax charge on any lump sum you take from the pension over that amount, or a 25% additional tax charge on income, a 25% tax before any income tax that's due. So it's really, really important to understand your numbers in regards to your lifetime allowance, and also in terms of annual allowance, because that's an additional annual charge through self-assessment you need to make if you're breaching the amount that you're paying into a pension on a regular basis. It's important to understand your numbers both now and of course in the future as well, because this is based not just on the value today, but the growth. In terms of opportunities around mitigating for that tax liability, there is protection still available. There's both individual protection 2016, fixed protection 2016, and there's also a less widely known potential to apply for an international enhancement if you remained a member of a pension scheme whilst you're overseas, based on being described as a relevant overseas individual. Again, we can cover that in a bit more detail if you want to have a chat about that separately or through the Q&A. So next slide, and I'll pass you over to Kelly, unless you've got any further comments on the pension.
Okay, so one of the key things that is often not addressed is planning when thinking of repatriation. So we often get contacted by individuals who have left the UK to go overseas and now thinking of moving back. But usually they come to us a couple of weeks before their move date. And the key message that I'd like you to take away in respect of this point is that timing is everything. And the more notice you can give your advisors, the better. There is a lot of opportunities that are available if you plan properly, and I don't have time to obviously go through all of them, but things like making sure that if you have losses on investments, you might want to keep those losses and not encash them before you move back to the UK, but wait until you're moved to the UK. But similarly with gains, we would encourage you to wash out those gains, so cash in investments that are standing at a gain prior to your move back to the UK from a tax perspective, but obviously only if that's the right thing to do. You do need to be aware though of the temporary non-residence rules. So if you have only left the UK for less than 5 tax years and you've then gone on a mammoth exercise of cashing in and making heavy gains, once you return to the UK, you will be taxed on them. So the exercise for washing out gains only really is helpful for those that have been outside of the UK for more than 5 tax years. The key message again: plan early and take good advice. There are other options for people that are moving to the UK that perhaps have never lived in the UK. Things like excluded property trust, no inheritance tax, but Giles will be covering those slightly later. And then the key message: surrendering investment at the wrong time or arranging them in an appropriate manner can lead to significant and unexpected tax consequences. And the real key is that you don't want to go into the UK and find yourself owing HMRC a humongous amount of tax when you've only been there for a short time. So try and get your affairs in order before you go back.
If you are thinking or currently in the process of transferring a DB scheme, a defined benefit pension scheme currently, then please stop, take a deep breath and consider how you actually got here. For total transparency, I'm a specialist in this area, holding all the necessary qualifications, accreditations to provide specialist advice for defined benefit pension transfers. I look at a lot of defined benefit pension transfers, and 9 out of 10 we recommend for people to stay, which is why I get incredibly annoyed when I get pestered with Facebook messages and or Instagram messages from international pension providers, financial advisors trying to sell me the idea of transferring a pension. In fact, the FCA's guidance on this is to start from a position of assuming that you shouldn't do it, and that is basically because you're moving from something, or moving away from something that is guaranteed to something that is not. That said, there is many reasons why a transfer of a defined benefit pension scheme can be in one's best interest to move, particularly if you're very close to retirement, particularly if you're very certain about what retirement looks like, and that you know that you don't need the guaranteed income available. The ability to be able to transfer a guaranteed income for cash or cash value can be incredibly beneficial, particularly when it comes to legacy planning for families. The ability to transfer an amount of money to future generations, not just sons and daughters, but grandchildren, etc. The important points here are to review your current benefits versus your needs. Carry out cash modeling, looking at what your future needs might look like, and that's something, again, we're very happy to help with here. And consider how pensions fit in with your overall strategy. As I mentioned, it's rather counterintuitive, but we often talk about pensions as the last thing that you might touch in retirement, particularly if you have other investment sources, be it fixed assets like property or liquid assets like investment portfolios. Because the pension sits already outside of your estate from an inheritance tax perspective, it can be much more beneficial to leave that invested as a pension for future generations. Next slide.
Okay, so you've spent a long time sort of building up your wealth, and you're getting to yourself to a point where you're financially stable, and you're living quite happily. So the key then message is not to give it all away to the tax man. So don't pay any more tax than you have to, and in order to do that, you need to take good advice about the options that are available. Next slide, please. But you do need to be aware of the scandals that exist. So this is a quote from the Society of Trusted Estate Practitioners, but it is not unique. This involved some promoters of asset protection trusts who have actually been jailed for mis-selling. And I think the whole profession, when we read things like this, are saying finally, because this goes on all too often. There are a number of outfits who usually advertise on the internet, and they will sell you a dream. Things like you give your house away and stay living in it, and that's fine because you've removed your estate from your estate for tax purposes. You haven't. You give your house away into a trust, continue living there, and it won't be taken into account for care home fees. That doesn't work either. But what you have done is you've paid usually an extortionate amount of money to an online provider for bad advice. And we are seeing these people get punished. But unfortunately, in my many years of advising clients where we're trying to unwind these schemes, the problem that we face is that most of these individuals or these companies are not insured. And so by the time you try to take action against them for the bad advice, you can't recover the damages because they've gone out of business. So it's really important that you take advice from people that are adequately qualified, they are regulated and they're insured. Having said that, trusts have many, many uses. They are a brilliant thing when used appropriately. They can help with inheritance tax planning and they can help with asset protection. So they can ensure that if you want to provide assets to your children, that the children are old enough and mature enough to receive that money. They can ensure that it doesn't get taken away if one of your children gets divorced or if they become bankrupt. So they have many, many uses. And then for those that are have bigger estates, family investment companies are a big thing, especially in the UK, and they are very similar to trust structures, but they protect the assets for the next generation. The other sort of mis-selling scandal that we're seeing is people transferring assets into trust to avoid probate fees. Not really realising that in the UK, a grant of probate is £225 sterling, yet people will be spending £3,000–4,000 to place assets into trust to avoid the £225 because it's not sold to them appropriately. So there are a lot of bad guys out there. Make sure that you take proper advice and make sure you check the credentials, but there are options to save tax and protect the assets. Next slide.
But inheritance tax is the biggest. It's actually a completely voluntary tax. Mixed domicile marriages where you've got a UK dom and a non-dom. There's also lots of threats as well with those situations. We always suggest that clients take advantage of annual gifting opportunities through exemptions, etc. It's really, really important that you're aware of the difference between domicile and residency and the implications of both. It was very interesting recently with Rishi Sunak's wife and the amount of experts that suddenly appeared on Twitter who seemed to understand the concept of domicility and were quite dangerous in some of the assumptions that they made. Of course, the easiest way to reduce your or completely remove your inheritance tax liability is to entirely give away your estate, or indeed spend it entirely before you die. And that would be very easy if you knew when that was exactly, which of course we don't. But as I mentioned, with careful planning, working with experts like Kelly and myself, it's very, very possible to completely mitigate any inheritance tax liability. And so more of what you've earned over your lifetime is passed to your dependents and your loved ones. So the must-dos here is to review, in the first instance, your IHT position, to actually understand what that looks like and how much, if anything were to happen to you today, that would be, and how much the tax liability would be to the UK government. Of course, as part of that, understand completely the opportunities to mitigate those liabilities. Look at trust planning, as Kelly mentioned, and family investment companies, something that we're doing more and more of from Singapore here. And for non-DOMs considering a permanent move to the UK, look at the use of excluded property trusts for offshore assets. Again, something that we can help with. Over to you, Kelly.
Yeah, and so I was just going to add on that particular topic is making sure that any actions that you do are evidenced and that you keep that evidence. So there are many exemptions that you can use to avoid inheritance tax. Things like using your income, so you've got an annual gifting allowance that you can utilize. You've got a excess income allowance, which is basically if you take all of your income into account, take off your expenditure, whatever's left you can gift away, inheritance tax free. However, it's really important to remember that when you die, your executors have a role to report all of this to HMRC. And there's a very detailed form that has to be completed. And as a executor, I've acted many times as an executor. It can be an absolute nightmare to put this form together if the deceased hasn't left appropriate records. And of course, if the records don't exist, then everything falls in favour of HMRC. So you might have done everything right and you might have complied completely with the law, and the inheritance tax may not be due, but if we can't evidence it, then we can't prove that, and therefore you end up with a bigger bill than you intended. And this is why it's also a good idea to work with advisors who can give you the appropriate tools to put that to evidence those reasonings. Next. Right, okay, so wills, guardianships and powers of attorney. So probably two of the most important documents that you will put in place in your lifetime. One is your will, which governs what happens to your assets and your estate when you die, and your power of attorney, which governs what happens to your estate while you're alive. People think the powers of attorney are for old people. I can guarantee you that's not true. It's really, really important that you have that in place really from the age of 18, because if something does happen to you, you lose mental capacity, you get run over by a bus, you're in a coma in a hospital, nobody has authority to look after your affairs. I've had clients assume that because they're married, their spouse will have the authority. They don't. And we are finding that government organisations are really tightening down on this and refusing to give any information and hiding behind sort of data protection. So you'll also find that the banks will completely close down on you, and accounts will be frozen. You've got no access to money. And if you are in a relationship where perhaps you share one bank account, that can be really difficult. So that if there's a joint bank account, definitely in the UK, most banks will freeze that joint bank account if one person loses capacity. So suddenly you're left in a position where you've got no access to money. And then with your wills, you've obviously spent a long time building up that wealth. Why do you want to leave it to the government effectively to decide where your assets pass and who receives them? If you've got assets in multiple jurisdictions, one of the common questions is going to be whether you have one document or many documents, and that applies for wills and powers of attorney. So looking at wills first, should you just have one will that covers all of your worldwide assets, or should you have a will in each different jurisdiction that you hold assets? And there are pros and cons for each one. If you have a worldwide will, that covers assets in all of your jurisdictions that you hold assets, some of the fallbacks you'll find is that perhaps you haven't taken appropriate advice in all of the jurisdictions as to what happens in the assets, in what happens to the assets on death. So some countries will have forced heirship laws, or may be bound by a Sharia law, and have certain specific beneficiaries that have to inherit, which may mean that your will is suddenly found to be invalid. Others don't, especially civil law jurisdictions, don't recognise the use of trust. So you might have done all of this work to put an effective trust in place and find yourself or your estate's in a bit of a pickle because the jurisdiction doesn't recognise a trust. And so I've had a case very recently where a French resident was appointed as a trustee of a will. They weren't due to inherit anything under the will, but the French authorities taxed them as if they owned their asset when they had no entitlement to it at all. The other issue you can find if you have one global will that covers all of your assets is that it takes a long time to administer your estate, and that's because your will has to be proved in each jurisdiction. So you may take it to the UK, you take it through the probate courts in the UK, that will take some time. You then need to retrieve it and take it through the courts in Singapore. It's probably a little bit more efficient because Singapore tends to be more efficient than the UK, but there we go. And then you move on to your next jurisdiction. And especially if you are domiciled in the UK, HMRC want that tax on all your worldwide assets pretty much straight away, whereas you're not going to be able to access those assets until you've proven the will in each of those jurisdictions. However, one of the benefits of a will covering everything is obviously nothing gets missed. Our advice, though, is to have different wills in different jurisdictions, but making sure that you have one individual that takes control over all of those aspects and makes sure that they tie together. And a similar point for powers of attorney. So you can have a power of attorney in a foreign jurisdiction and it can be proven in other jurisdictions, but it does have to go through a court procedure. And so if I take again the example of the UK, if you've got a power of attorney from a non-UK power of attorney, then technically you should be able to take it into the UK and take it to a UK bank, and they should recognise it. But the reality is that doesn't happen. And so what you need to do is you need to take it to the court and get a declaration of enforceability. Now, at the moment, those declarations are taking about 12 months to come through. So you've got a 12-month wait before you can access money. So the key there is to take advice and make sure you've got wills, powers of attorney in multiple jurisdictions, and that they're all tied together. And then I just wanted to touch a little bit around deathbed planning. It sounds a bit crass, but actually it can be really effective in the UK, especially with some of the exemptions we have now with things like the residence nil rate band. So if you haven't taken advice and you think you have left it too late, there are still some options available. Obviously the options are minimized, but there are some options. Next slide. And this is my key takeaway. So half of adults that have either UK assets or are living or situated in the UK don't have a valid will, yet 1 in 4 of their estates are contested. And the fun fact that I like to throw out is if your estate is contested, the average cost for legal fees in a contested estate is about £250,000 in sterling in the UK. And that's the average. So there are many, many, many more that go above that. And so it's really worth spending time and money to get things right before you go than leaving it to be contested after your death. And apart from the cost side of things, those relationships hardly ever recover. And so you're damaging the future relationships of your family as well by not planning effectively. Next slide. Oh. Compliance. Okay, this is me again. So in an increasingly global world, we are finding reporting requirements getting more and more and more. So the OECD treaty allows for collection of taxes in foreign jurisdictions. This goes against the sort of common law, revenue law, which was that another jurisdiction could not collect the taxes of a jurisdiction. So if I left the UK, having not paid HMRC, came to Singapore, the basis point is that Singapore can't collect taxes on behalf of the UK government. The treaties that are now being entered into allow that to happen. And not only do they allow that to happen, they allow governments to also freeze my assets until I have paid my taxes. So compliance is really, really important. It's very dull. I won't pretend it's not, but it's really, really important, and it's ever changing. So we have things like the trust register in the UK now. So if you set up a UK trust in the past, then you have until September to actually register with HMRC. If you set it up since September last year, then you have only 30 days to register it before HMRC will impose fines and penalties on you. We've got the non-resident landlord reporting requirements. So if you own property in the UK, you need to make sure that that's registered with HMRC, and you can apply to receive rental gross, but only if you meet certain criteria and HMRC think that you're going to complete your tax return. If you sell property in the UK, you need to make sure that you complete your capital gains tax return on an annual basis. And if it is UK residential property, you now only have 60 days from the date of completion to file a CGT return and pay the necessary capital gains tax, which is always a bit of a tricky one because you're not necessarily sure what your overall capital gains tax liability will be. But nevertheless, HMRC wanted to accelerate the receipt of taxes for properties. And so you've got 60 days in which to pay that. And that's catching quite a lot of people out who assume that they've got their regular year to file. So the real message on the compliance front is to know your time limits, know your duties and responsibilities, and also understand how local law impacts on global tax requirements. So if there is a double tax treaty in place, don't assume that it necessarily applies to all taxes. Often they don't. And don't assume that just because you've paid tax in one jurisdiction that there will be no tax payable in another jurisdiction. Doesn't quite work like that, and each treaty has its own nuances. We don't have a sort of global treaty that it applies to all jurisdictions. Just doesn't work like that. It would make it too simple. Next slide. So this is just some light-hearted quotes. So a fine is a tax for doing something wrong. A tax is a fine for doing something right. But if you don't file in time, then you're going to pay both. So it's worth just getting things in order, getting organised, and making sure that you are compliant. And today it takes more brains and efforts to make out the income tax form than it does to make the income. And unfortunately, that can be true. So it's better that you take advice to make sure that you're claiming all the exemptions that you are entitled to. And we can hopefully take that stress and angst away from you by completing your affairs and filing them for you. Next slide. Giles.
Yeah, I think that. Yeah, I think yes, that is me again, Kelly. Thanks, Kelly. That's excellent. So this is sort of rounding off everything that we've talked about. I mean, I've been in Asia since 2012, and I never cease to be slightly disappointed with a lot of the financial advice firms, stroke banks, in the fact that they often only focus on one thing, which is the investment. It's very transactional in nature. And I think, as we've spoken about today, and hopefully the people on the call have discovered, financial planning, real financial planning, is a much, much wider subject than that. It covers, wills, tax, power of attorney, estate planning, understanding how much is enough through cash modelling, looking at the future, later life planning, family legacy, long-term care trusts, and tax compliance. And we've built a business, and because we think it's very important that we can create a one-stop shop where clients can work with one person as their trusted advisor that can coordinate all of those aspects, most of which we can do in-house. To carry out regular reviews, not just on a client's individual situation and position, but also regulatory changes. As we've talked about earlier, they're likely to come thick and fast as governments look to tax more and more. And we like to, as I mentioned, I think earlier, to do as much of that in-house as possible, but equally work with external advisors as and when necessary, with the ability to provide advice internationally, but also, as Ian mentioned right at the beginning, with a very, very strong UK footprint as well to support your loved ones back in the UK. That's us for now, and I'll pass it over to Ian in a second. I said apologies for the lack of sound earlier. I did put to the test, and I'm hoping I'm not going to feature in a BritCham webinar in the future about 8 reasons why you might get divorced, one of which is trying to do a webinar while you're on holiday. But as long as I'm not, then all good by me, and I'll pass you back to Ian.
Thanks, Giles. Helen, if you could flick to the next slide, that would be fantastic. Actually, Giles has covered this, so we'll skip on if that's okay. Thank you very much. So I've been looking out for some questions as we go along. I haven't had any as yet, which probably means that Kelly and Giles have done such a fantastic and comprehensive job of delivering all the information that everybody has written. Tons of notes are going to call themselves to action. If you do have any questions, over the course of the next few minutes or so, then please raise your hand and pop a question, and I or the team will be really, really delighted to help. Next slide, please, Kelly. Really want to reaffirm, what the guys have said. So ultimately, we are very much a business that's here in Asia that is looking to offer help and support for anybody about anything to do with financial advice, wealth management, pensions, tax, legacy or estate planning. And we are that place where you can come and have a great experience here in Asia, and that experience is followed through and backed up by a great team in the UK. That puts us in a very unique position that we really can help people with issues around taxation in both those countries, but also help those people in expat and repatriation processes, and also ensure that we give the continuation of our great advice and servicing when people leave or join those relevant countries. We have a fantastic tax team here in the UK, in Singapore, backed up by a tax team in the UK. There's a QR code on the site that you can see here. That will take you straight through to our website, and via the website, you can get in touch with us. We would be delighted very much to talk to anybody. We believe that we will always be able to offer somebody a fantastic and great tip. So if the least that you've got from today is a call to action to get your wills in place, take a look at your pensions, or simply just set up a meeting with one of the great team and get some advice about your unique position, then please get in touch. Thank you once again. We'll end the webinar now. There's obviously a recording, so if for whatever reason you wanted to watch it again and experience any of this, which of course all of you will, then Helen will be no doubt posting it on the BritCham website very soon. Thank you and have a great evening, everybody.